Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. All the talk in commodities right now is about iron ore and maybe copper as well. But iron ore, spot prices fell below $100 a tonne over the past 36 hours before rebounding a bit. Of course, this has huge significance for Australian miners and our economy because it makes up such a large portion of our exports. Vivek Dhar is the Director of Mining and Energy Commodities Research at Commonwealth Bank. Vivek, you're almost a regular on Fear and Greed. Welcome back.
No, thank you.
All eyes on China right now, I suppose.
Yeah, look, in terms of what's happened with iron ore prices, we have certainly seen prices descend. It started this year just north of 140, and now we have tested that $100 a tonne mark. And spot prices are still just above it, but as you said, it's very much nearing that level. And really what's driven it has been Chinese demand concerns. And it has really pressed on steel mill margins in China. And so long as we have that pressure point, particularly from China's property sector, that's really what's caused this fall so far in iron ore.
Can we just take a step deeper into that, what you just said? So the steel mills are the biggest buyers of iron ore in the world, the Chinese steel mills. They're creating steel for the residential property market primarily? That's a question, not a statement.
Look, the property construction side accounts for about 30 to 35% of China's steel consumption, right? And then your infrastructure side is about 25 to 30%. So when we really map China's steel consumption, it is basically thinking about what is property going to do and what is infrastructure going to do. And that really is how we sum up the China demand view.
And the problem at the moment is certainly, and on the property market at least, there's been an oversupply in recent decades, or the last decade or so, and so we're just not expecting to see the same demand or building demand over the next decade. Is that the story?
Look, it's probably a bit less of a long-term picture and more short-term in terms of what's playing out. Like this is very much a housing crisis. We've seen for the last 9 months to February, we've seen new home prices in China descend, and it's not looking like it's going to improve. But on top of that, what has happened, particularly over the last few years, has been the health of China's property developer sector has been very, very weak. Now, this is very much a vicious cycle. So you can imagine if you have, new house prices falling and you have property developer credit conditions becoming worse, they feed back on each other. And what it means is that you need policy intervention to come in a big way.
The property sector is critical here, Vivek. I mean, is it a situation where there's been an overbuild for the last decade and then, it's going to take years to sort that out, or what?
So look, the situation with China's property sector is actually more to do what's happened effectively post-COVID. There has been a slowdown over the last 10 years. There's no doubt about it. But in terms of just how things have deteriorated, you can see that in two ways. One is new home property prices in China have declined for 9 consecutive months to February. Now, on top of that, what we're seeing is the health of China's property developer sector is also very weak. And this is something that's both combining in a vicious cycle to really push down pressure on new property construction. And this is really critical for steel. This is the most steel-intensive component. And to put into perspective just how weak this element is, look, it was down 39% year on year in 2022. It was down, 21% last year. And in the first 2 months of this year, it's down over 30% year on year again. So it's very much where the pain point is new construction just has no incentive right now.
Can I also ask, with these steel mills, they talk about their inventory checks in May. I'm not quite sure. Can you explain what that is?
So what you often see, it's often at the start of the year. You'll see steel mills and inventory generally rise as we kind of go through the construction season, which is March till October, November. So during this period, you start seeing a fair bit of construction activity. And so, we do see seasonal pickups, right? So, look, inventory is certainly one aspect to watch very closely. But if you look at actual activity, I think that gives you a better sense of just how that demand is really struggling right now.
Stay with me, Vivek. We'll be back in a minute. My guest this morning is Vivek Dhar, Director of Mining and Energy Commodities Research at Commonwealth Bank. So what's it mean for the big miners, for the BHPs and Rio and Fortescue? And I'm not asking you to comment on specifically, and no investment advice here, nothing like that. Just generally, what's that mean for the miners and also for the Australian government and the budget?
Yeah, look, in terms of the direct implication, right, that it just means you have lower margins, but it doesn't mean that it's not very, very strong. Like the delivered costs when we talk about, say, Rio, BHP, Fortescue into China, we're talking $30 to $35 a ton delivered into China. So, at these prices of $100 a ton, they are still making enormous, amount of cash windfall. So it's still very, very strong. So I certainly wouldn't be saying that it's negative if we talk about any kind of risk to mining activity. But when we then look at, say, government projections and what they're expecting, look, if these spot prices remain for this financial year, we're talking an upgrade in terms of the tax receipts for the federal government of about 800 to 850 million. But you then look at next financial year, if these spot prices remain, we're talking about 1.4 to 1.5 billion in terms of tax receipts. Now, these sound like big numbers, but in terms of for the federal government, it's not going to really move the dial. So it's they have a very conservative forecast, and it's very much should be seen as a budget as opposed to a forecast.
Okay. And I mean, the very conservative forecast, if you look at the long-term price of iron ore, we're still reasonably high, aren't we? Even at $100.
That's right. So the government's forecast is about $60 a ton by third quarter, and that's FOB Australia. So if you convert that to a CFR price, which is what the main benchmark is measured in, we're talking, say, something closer to $70 a ton. So at $100 a ton, we're well above that level. But there is actually cost support at these levels when we talk about current pricing. So, one of the biggest shifts in this market, which happened in early 2019, was when we saw this fatal dam collapse in Brazil. Now, when that happened, Vale lost tons from the market, so a lot of seaborne supply had to exit, and that was replaced with high-cost supply. And as that has come in, that is really what has supported pricing in that $100 a ton plus mark. And it takes a lot for prices to stay in $80 to $100 a ton, because it means you're basically telling seaborne supply to exit. And so far, we don't think that's the signal that needs to be sent. So even though prices can move below 100, we don't think it'll sustainably stay here. We think it'll likely stabilize between $100 to $110 a ton.
Okay. Let's move on to copper. When I was growing up trying to learn economics, copper was like the bellwether commodity. What copper did was a pretty good indicator of how things were going. Copper prices are very high at the moment. Why is that? And is it still a bellwether?
It depends what drives it. So copper, because it's used in so many end-use sectors, right, it is traditionally seen as the bellwether because it gives you a health of, okay, how are people consuming goods? But in terms of what has driven the pricing, I think it matters. And what has driven it, particularly in the last few weeks, has been actually supply disruptions. So we saw Chinese copper smelters come out and signal that they were looking to slow down copper refined production, which is really a signal that there has been supply disruption in this market. And that's certainly been the case. The big one has been a mine in Panama, which accounts for about 1.5% of global copper supply. But it has really set the tone for the market that we're going to see supply disruptions, and that may lead to deficits. And so that's really what's led to copper. If you look at 3-month copper futures, it's come up to above $9,000 a ton. And that's really been an elevation compared to what people expected.
Okay, the other one I just want to quickly mention is coal, because it's such a big export of Australia. It's obviously we're way below the peaks that we had when the war in Europe commenced. It's fallen back, but it's kind of, it's not quite at the levels that it was pre-pandemic, is it? It's still elevated compared to that.
Yeah, look, it depends on which coal you're referring to, but on both coals. Look, the bigger correction, I'd say, has so far happened in thermal coal. And the reason why that has corrected lower is that it often competes with gas for your marginal power generation in Asia. And because gas markets, particularly in Europe, have proven to be far better supply than people thought. So stockpiles in Europe, for example, they are at this time of year about 60 to 65% right now. For this time of year, it should be about 40 to 45% of capacity at the gas storage levels. Because that is so well supplied, we've seen gas prices come off, particularly LNG spot prices, and that means thermal coal, which competes with it, has also had to come off. So both of those factors in terms of the thermal and gas kind of switching story has really played into this thermal coal price that has fallen. But to your point on coking coal, this has also fallen quite significantly, particularly since the beginning of March. And really what's driven the coking coal dynamic, for the last, I'd say, since October till January, supply disruptions have kept coking coal prices above $300 a ton. But then what we've seen is we now know where China is heading with policy. And that has really started weighing on that demand side. And those supply disruptions have eased. So we've now seen coking coal come well under $300 a ton, and now closer to $250 than $300. So we've seen these dynamics now play out. But as you said, there is still this premium in the market compared to what it was pre-COVID, and that's really a function of supply disruptions that have really been there since the Ukraine war because Russia is such a big supplier. So we are watching the space very closely. But yes, certainly I would say that it's higher than what it was pre-COVID. But it's certainly much closer to it than it was just a couple of years ago.
Vivek, thank you for talking to Fear and Greed.
Oh, thank you.
That was Vivek Dhar, Director of Mining and Energy Commodities Research at the Commonwealth Bank. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.